Good morning or good afternoon, depending on where you are. Thank you for joining us today for our discussion on wildfires and related insurance coverage considerations for impacted industries. We will start off today with just some brief introduction of our panelists, and then we will dive right into the topic. We'll let everyone introduce themselves. I'm Sandy Thayer. I'm a partner in McGuireWoods Los Angeles office. I've been practicing insurance coverage attorney for well over 25 years. I specialize in representing energy companies in connection with wildfire liabilities. Over the past 15 or so years, I have represented energy companies in California in some of the largest, connection with some of the largest wildfires in California.
And I'm Drew Gann. Yep, thank you, Sandy. Drew Gann. I'm a partner in our Richmond and Charlottesville, Virginia offices. I'm a member of the McGuireWoods' crisis management incident response team, in addition to the energy litigation team, specifically to wildfires. I currently represent dozens of companies, mainly energy companies, nationwide as it relates to wildfires. Specifically, I just got off the phone right before joining this webinar about a wildfire that's occurring as we speak in Pennsylvania. So I have a lot of experience in the incident response and the subsequent litigation aspect of it. Michaela, I'll pass it to you.
Thanks, Drew. My name is Michaela Whitman, and I'm a partner in the McGuireWoods insurance recovery practice, and I split my time between the New York and the Los Angeles offices. I recently turned from a 2 years secondment at AECOM, where I was part of the risk management group and corporate legal team, and I advised on all insurance coverage issues across their global portfolio, including wildfires and related coverage. So diving in here, we have a full hour on wildfires and insurance. First, we'll provide an overview of wildfires. Next, we will discuss the legal landscape of wildfires, going through litigation, mitigation, operations, regulatory and legislation, governance, and incident response. Then we will turn to the more nitty-gritty of the insurance aspect of it, including pre-wildfire, what are your considerations in procuring coverage, and post-wild considerations in insurance coverage. I'm going to turn it back to Drew now to kick us off.
Yeah, thank you, Michaela. And before I get started, I think people on their screen have a question and answer box. If you want to ask anything or make any comments during it, I'll do my best to try to read those and respond to those in real time if possible. And if not, then we'll try to follow up after the webinar. So just to start off with a little bit of background on wildfires, and probably a lot of people don't need this because you're here, but the first thing is the term wildfire has really no single specific definition, and it's debated, and that'll be discussed why that's important both in the operation side of things. It's also important in the insurance side of things, which will be discussed later. But in the industry, you hear a lot of people use two separate terms. One is wildland fire and the other one is wildfire. Specifically, wildland fires includes both prescribed, which are planned, intentionally set fires to lower the fuel load in specific areas to hopefully prevent or slow wildfires in the future. And wildfires, which includes what we're talking about, which is the unplanned, uncontrolled burning of areas outside of urban interface. So we'll talk a little bit more about wildfire season later, which is why it's in quotes here, but wildfire season every year burns millions of acres across the United States. And while wildfire season had typically been between May and October, November, depending on where you're at in the U.S., the question is whether that still remains. The reason why the summer months were always considered historically the worst for wildfires is because it's hot and dry. There's no rain or snow that kind of puts moisture in the ground, which allows the fuel to be easier to burn and fires easier to spread. There's usually gusty winds, and then obviously the thunderstorms that occur during the summers provides lightning, which is a significant source of ignition, and then the subsequent burn. So while wildfire season historically had been through there, that's kind of the reason why summer months were considered the highest risk or highest exposure. And generally speaking, when you look at the stats, wildfire season, if you look at it from the number of fires and the number of acres, it has seemingly stayed steady over the past 10 years. But the problem is now it's kind of the top of the news cycle. You read about it every day, you hear about it every day. And a lot of that is because of the specific risk and exposure that is being put on specifically energy, electric utility companies. But if you kind of look at the stats, and I've looked at it going back to 1983, there has been an increase within the past about 15 years. But if you look at the past 10 years, it kind of fluctuates up and down within some parameters. Going back to wildfire season, so many states continue to experience larger and more frequent wildfires. Just as of an hour ago, when I was looking at the map, there's current wildfires in New Jersey, Pennsylvania, West Virginia, North Carolina, South Carolina, and Florida that's being reported. And then if you also look at the map, the Midwest has significant number of hotspots that are being detected that may or may not result in wildfires. From the electric utility side, safely and reliably serving the customers while mitigating wildfires seems to be either the number one risk or certainly close to the top of the list. But the issue is now wildfire season, and the mitigation of wildfires is now a year-round job. And this is a quote from Governor Newsom after the January wildfires in LA, just saying that there is no season now and everyone needs to be prepared and continue to do work year round, which puts a lot of strain on operations. It puts a lot of strain on the companies as a whole, especially now they don't have a chance to set back and then create their plans for the next season. It's a constantly, you have to evolve as things move. Speaking of probably the number one example on this kind of falling back of wildfire season is the January fires from this year that I mentioned. Statistically, it was significantly or severely devastating, killed 29 people. It's now the Eaton fires and the Palisades fires now considered the second and third most destructive fires in California history. And the total economic loss will exceed $250 billion. And that was in January, when typically people did not consider that to be wildfire season or a significant risk for wildfire season in California. And the causes of those fires are still under investigation. Obviously, the investigation is ongoing and could take months to determine the actual cause, although there's a lot of speculation in the news and elsewhere on what the cause is. But some of the things that has been noted on why there was like a perfect timing of issues for this fire is there was the Santa Ana winds, there was vegetation, it was dry, it was a dry winter, so vegetation, there was a lot of fuel to burn, there was obviously severe drought in the area, and then kind of the two potential causes of ignition that have been talked about in the news is down power lines or alleged arson. But those investigations are still ongoing, and it could be months before we get a true answer. So wildfire season, for years, I'd always heard from different clients to think that it was just California or just the Pacific Northwest. That's not the case anymore, and I think everyone beginning to recognize that. As I mentioned earlier, most of the wildfires occurring as we speak are East Coast, and many states are experiencing larger and more frequent wildfires than they ever had before. Many states had wildfires previously, but they, one, never got on the news, and then two, were usually able to be contained and extinguished fairly quickly before they got out of hand. This list shows the current states battling wildfires under red flag warnings. This was actually created a week or so ago when we were finalizing the PowerPoint, and this list is actually longer now within the past 24 hours. And every region of the United States is currently impacted by wildfire or wildfire risk based on either red flag warnings or currently battling active wildfires. Again, this was pulled March 30th, 2025. So obviously this is a little bit outdated, but it just shows the various active wildfires that were being reported at this time, along with the red flag warnings, which shows that even during this time in March, which obviously historically was not wildfire season, every region of the U.S. had some impact or some risk as it related to wildfires, including potential red spots that could be deemed to turn into a wildfire. So moving into the litigation or the legal landscape. So over the past decade, wildfire litigation has increased, specifically against regulated electric utility companies. And the focus of all this litigation, and we'll talk a little bit about the causes of action that these plaintiffs bring, but the focus is really on the industry standard. What does a reasonably prudent business do in this circumstance? And in the electric utility world, the battle is on the differences amongst the regions and the states. And plaintiffs will always point to California because, one, they're probably a decade advance on wildfire risk, and two, they spend a significant amount of money mitigating the risk of wildfires. And they can always point to what a utility is doing in California and say, they did it, why didn't a utility in Virginia or West Virginia do the same thing? And so the battle is always on those differences and making sure that those differences hold true and that the industry standard is not created by a state or a situation that is different. So the focus on wildfire litigation from a what is the causation standpoint is both ignition and exacerbation. Ignition's easy. The electric utilities line down caused the spark that started the wildfire. Exacerbation gets a little bit harder, especially in the world of questioning whether they should proactively de-energize lines, electric lines, as wildfires approach right away, whether they should be underground power lines, whether the vegetation control, not that it ignited the wildfire, but that if they would have done proper vegetation control, it would have done fire breaks and allowed the fire departments to stop the wildfire from spreading. So those are all the issues that, at least in the electric utility world, that is being considered both from an ignition side of things to an exacerbation side of things. And the exacerbation is a harder issue to maintain and to also understand where they're going. Ignition, again, you're focused on the origin of the fire, and the cause, specifically exacerbation, could be acres and acres away from the actual cause and origin. So in the beginning in California, when these first lawsuits were brought, they were brought under an inverse condemnation theory because that was akin to a strict liability. It's the idea that if a wildfire is started by a utility and it encroaches on someone's land, then the utility must pay for that. And most importantly, from a risk perspective, it allowed the plaintiffs to recover attorney's fees and costs, depending on the specific state statute at issue. More recently, I think plaintiffs have kind of gotten away from the idea that the inverse condemnation is so great. They still bring it because they still want the attorney's fees and costs, but now their focus, as I mentioned, on the industry standard and pointing to what this utility could have done or should have done that another utility was doing, even if it was across the United States or elsewhere. So they've expanded it to the more type of tort actions you would see in a normal tort case. But the focus really for that is to be able to bring in what other utilities are doing, what the industry standard is. And the view is that once a jury hears what other utilities are doing, and if they would have just spent $5 extra per customer on X, it would have prevented this catastrophic wildfire. That's what inflames the juries and causes them to bring back larger verdicts or drives up the settlement costs. So that's why the focus now is more on this normal tort theory rather than an inverse condemnation, where the cause really isn't the issue. It's did they ignite the fire or exacerbate it, and did it damage the property? It doesn't really get into what they could or should have done differently. and I know I've talked a lot about electric utilities, but wildfire litigation is not limited to electric utilities. This is just a more recent example of a water company that was sued for the Pacific Palisades because they believed that they had run down their water supply and therefore had inadequate supply of water to fight the fire. And so the idea here is that if they would have kept the water supply as they should have, then the fire department would have had sufficient resources to stop the spread of the fire. And this is another additional allegations here. But we've seen other non-electric utility claims. We've seen them against contractors. Contractors can be sued for ignition as well. Grinding equipment causes a spark, causes a wildfire. I've seen contractors get sued for inspection activities. They should have inspected X, Y, or Z, or should have done things, and they weren't even on the site at the ignition, but they should have done something prior to, which would have prevented it. We've seen it against other energy companies. Pipelines haven't been sued yet, but there's a lot of pipeline companies that are really nervous about the potential to be sued. Renewable companies are nervous about it, especially battery storage facilities. So this is top of mind, not just for electric utilities, but I would say the energy industry as a whole, and any type of industry that touches in the energy industry, especially contractors that work day to day in the field. So because electric utilities have been kind of tested in this area, I think they're a perfect example of what the appropriate approach could be or should be considered in mitigating wildfires. So here, as it mentions, the Western utilities specifically have considered, tested, and implemented wildfire mitigation practice for more than a decade. So I think we should look at those as an example, at least as a starting point. And essentially, it's a four-pronged mitigation plan approach that takes in operations, regulatory, and legislation, which has really been taking off recently, governance and incident response, and then at the end, which we'll spend a lot of time on, is insurance and indemnity obligations. So starting with operations. So operations is really where the rubber meets the road on the industry standard. It is the development of the industry standard for the specific electric utility at issue, and it's the determination of compliance to that industry standard. And what we've seen is that these 5 areas are areas that the electric utilities, each of them, consider in determining what they should or should not be doing when it comes to wildfire mitigation. Just to walk through some of them, vegetation management is obviously the active management of trees and other vegetation in the right-of-ways. That includes using herbicides. That includes DSAP, which is the defensible space around poles, clearing the poles to make sure that there's no vegetation that can be sparked and caused to be ignited. There's proactive tree trimming. There's removal of hazard trees that could fall on the infrastructure and cause a fire. And then there's always the debate and this will be brought up in some of this other stuff, is how often you should do it, what should the cycle be? Because no company has unlimited money, so therefore a decision has to be made on what's the cycle should be, how often they should do it, and what is the standard for doing that. And that is the issue really for the industry standard, that it turns into being company specific at a base, but region or state specific, and you don't want to be held to a standard of what another company's doing in another state that has different risk profile. There's also a lot of different vegetation management technology. I would say there's pole maintenance issues, there's drone surveillance to determine whether the herbicide is holding, to determine whether things are growing more than what they should have. There's a lot of technology out there that electric utilities are using to try to make sure that their system is up to par. There's also inspections, enhanced inspections of distribution lines and transmission lines, and the wood pole inspections. Again, the big issue around those are the cycles, making sure that the cycles, inspection cycles are done in a way that's consistent with the industry, but again, with the idea that money is not unlimited, and therefore there needs to be decisions made on how that's done. Improved monitoring is a category in of itself. They use monitoring for all of this, but there's wildfire risk indexes, which is part of the risk modeling section. There's cameras that are strategically placed in sensitive areas to, one, determine whether vegetation is growing back, but also to see if there is an ignition to try to get it resolved as quickly as possible. Fires that aren't suppressed or begin to be suppressed quickly are the ones that get away, and that grow into the catastrophic wildfires that we see on the news. There's system and grid hardening, which is stronger transmission lines and power, instead of wooden power poles, steel power poles. There's undergrounding if you can do that, and there's all kinds of alternatives there. Again, those are very situation specific and also very expensive depending on where they're at in both on the system and region wide. And then the last thing is risk modeling. The idea here is just a lot of this is making a decision about what you should or shouldn't be doing, and limited number of dollars, moving them in the correct place to reduce the risk. And the risk modeling is really trying to put meat on that bone and make sure that you know where your risks are and doing the right things in those areas to do the proper thing to try to reduce the risk of a catastrophic wildfire. One thing that's not specifically mentioned in here, but it kind of goes into the idea of risk reduction or modeling is, and this is on the news a lot now, is the development of public safety power shutoff, referred to as PSPS. PSPS is the proactive de-energization or turning off of power in order to prevent a wildfire. And essentially what a company's doing there is it's balancing or comparing the risk and of the calculus of a wildfire versus risk to the customers without power. And there's significant risk on both of those, but it's trying to determine which risk is more and making the right decision based on that. And so PSPS criteria is usually based around the wind speed, the fuel, how dry it is, the humidity, things like that. And then you also need to take into account when you shut off the power, what's impacted. Is our hospital impacted that doesn't have generation or some other microgrid? Is there medically monitored people that's on the power that, hooked to an oxygen or otherwise can't fend for themselves? So that's just the balance of the risk, and that needs to be done, unfortunately, in order to make the decision on whether to do it. And then the last thing in the operations world that I've taken a lot of part of is for each of these, it's the tabletop exercises and simulations, especially with the PSPS. Those I cannot underscore how important those are. And every time I attend one, I just came back from one this week, I learn more, and there's always risk and issues that are out there that from a legal side, I don't think about, but operations knows, and they live in these communities, they work on these systems, they know about these systems, so keeping them involved in that is such an important aspect to all of this. So operations is first, going to the second is regulatory and legislation. So legislative efforts are mainly for electric utilities, but I think they, again, provide examples and considerations for non-electric utility companies, both what could happen and thinking about specifically the industry standards. So in the past 5 years, there have been a significant number of states that have adopted wildfire legislation, and you can see the list there that have the wildfire legislation. And there's a significant number of states this year that have proposed legislation that's currently moving through the legislators in each of those states. Essentially, the core elements of any wildfire mitigation legislation as it relates, as I said, to electric utilities is the electric utility develops and submits a wildfire mitigation plan, which is they will do X, Y, and Z. That plan is reviewed and approved by some governmental agency, and there's a determination on the implementation and compliance with that plan. And then if you are in compliance, you submit the plan and the utility is in compliance, then there is some kind of either protection or mechanism for cost recovery, and there's limitation of liability protection, which is kind of the carrot there that the utilities are looking for, is limiting the liability and having some kind of bounds into what available liability there is. Real quick before I go into it, so the thing about the wildfire mitigation plans is those really are what is trying to set the industry standard for not only state specific utility industry standard, but also the utility itself specific. And one way to kind of backdoor the industry standard is by putting in specific requirements for the wildfire mitigation plan into the legislation. So in every state, you will see specific requirements for the wildfire mitigation plan. And unfortunately, we don't have a lot of time to go through each of those, but that is one way to kind of use the legislation to set the industry standard. And I can tell you from experience, the Arizona legislation that's currently being considered will explicitly set the industry standard for that utility based on their wildfire mitigation plan. The other states have suggested that. They've gotten close to that line. Arizona will be the first state that actually clearly states that and puts that directly in the legislation if it is passed. From a limitation of liability standpoint, what we see is clarification about what constitutes negligent behavior, which is the attempt to try to set the industry standard. If you're complying with the wildfire mitigation plan, you can't be deemed negligent. There's usually a removal of punitive damages. Sometimes there's a limitation on the type of property damage claims that could be brought, or a cap on the potential damages. And then probably most important, if you can get it, is limiting bodily injury damages or limiting strict liability or inverse condemnation claims. I've been directly involved in some of the state legislative efforts, and I can tell you that there is difficulty associated with this process. From a drafting process standpoint, defining wildfires is where you usually start, and sometimes that's more difficult than you think. There's always an issue on how often to require submission of the wildfire mitigation plans, whether the requirement of submission can be optional if there is some smaller utility that doesn't have the time or resources to do it. Proposing the appropriate approval process, that's always a big issue, and how to ensure compliance is another, and making sure that the audit is set up in a way that people they don't lose the protection just because of some little minute deviation from the plan. So those are always issues in the drafting. And there's also other issues once it is drafted, getting it through the legislative process and approved. Getting the legislation passed, we get a lot of significant pushback on the plaintiffs' bar. They do not like these legislation. Insurance companies also do not like this legislation because they believe it's just cost shifting any issues from the utility to the insurance company, and they don't want to lose their rights to specific subrogation. And we've also had customers and consumers raise issues, especially if there is a cost recovery mechanism for the work that's being done, because they believe it will increase rates. So that was, so we've talked about operations, we've talked about regulations. So the third thing and last thing that I'm going to talk about is governance and incident response. So before there is a wildfire, to develop a wildfire response plan, usually that is done through a bolt-on to the current incident response or incident command plans, and determining what the triggering event is. Is it an acreage? Is it someone is injured? And then doing a structure from that, usually similar to any other incident command structure that the company uses for any other incident that they're dealing with. As with any incident, the first 24 hours are key. So the idea here is, obviously safety is the most important, making sure everyone's safe. But then once everything is safe, you notify and work with the proper authorities. That could include ATF, that could include federal forestry, if that's the issue, or state and local authorities. Establish procedures for privilege review, make sure that interviews are done, depending on if there's crews in the area that saw things or otherwise has evidence. And then making sure that you conduct environmental monitoring or any other type of monitoring that's very time specific. For example, smoke plumes, making sure you know the wind and the direction of that in case that's important for future litigated claims. And then probably from, here, I'll talk about the third thing here is the communications plan, making sure that working hand in hand with outward facing communications is always important, especially now that it becomes front page news anytime that there's a significant wildfire in any state. And then the idea of one of the things that's been the most important that we've seen since the Maui, Hawaii wildfires and the wildfires in Texas is preservation of evidence. And preservation of evidence is always a big deal because there's kind of two types of evidence that we see during a wildfire. There is the field evidence, which I'll talk a little bit more about. And then there's kind of what I call the remote evidence. And the remote evidence is the emails, the camera footage through AI cameras that can be accessed remotely, policies, procedures, and other data. And the idea of the remote evidence is to preserve before they auto-write or the auto-delete feature, which sometimes can occur in 24 hours. The field evidence is the actual evidence that's in the field, where the ignition source is as the fire moves through the system. And there you got to set up some kind of policy and procedure on how to do that. And normally what I do is I start with who has scene control. Because a lot of times, especially in the electric utility world, the electric utility only has specific land rights to right away. They don't have any other land rights. So unless the issue of being preserved is specifically in the right of way, there's sometimes the scene is engulfed in a larger scene. So you need to determine who has scene control. And if the utility doesn't have scene control, the objective there is see something, say something, making sure people don't destroy evidence or move things otherwise. If the utility does have scene control, the issue there is kind of twofold. One is a safety concern. And if it's a safety concern, you should do everything you can to make it safe. And while preserving evidence the best you can is important, making it safe is the most important. But the issue there is just make sure to never dispose of any evidence, and that all evidence should be maintained in the condition it was found, unless that condition itself poses the safety concern. And then once the safety concern is alleviated, you document it, you take photographs, you try to explain where it was when you found it, and what you had to do to alleviate the safety concern. And if there's not a safety concern, usually the goal for the field employees or field reps, because their goal is to get out there and get the system, the integrity of the system back, and to get the power back on. What you need to tell them is if there's no safety concern, don't touch or move anything, and just work through the appropriate chains in the company, whether that's legal or elsewhere, just to make sure that everything is documented in the appropriate manner. And then the last couple, I think, kind of touches more on what Sandy and Michaela is going to talk about. So I will turn that over to them on the insurance and indemnity side of things.
Thank you, Drew. I'll briefly talk about the pre-wildfire considerations and procuring coverage, and then I will turn it over to Michaela to talk about post-wildfire. As Drew mentioned, companies, especially electric utilities, they need to ensure that they have sufficient insurance coverage as part of their wildfire mitigation plans. This could be traditional insurance, or it could be one of the many alternative risk transfer vehicles that are out there in the market. Traditionally, insurers or insureds who might face potential liability for third-party claims for bodily injury and or property damage arising from a wildfire, including, electric utilities, tree trimmers, communication companies, anything sort of involved in that area, would procure commercial general liability insurance to cover that risk. And then those companies who, might find themselves in the path of a wildfire, who might suffer, potentially property damage or business interruption coverage, would turn to their traditional property insurance coverage to cover that risk. However, in recent years, as a result of the catastrophic wildfires and the increasing wildfire risk that we've seen, especially in states like California, traditional coverage for wildfire risk has been difficult to procure. Many companies have seen insurers adding wildfire exclusions or wildfire sum limits to their policies. Similarly, insurers in fire-prone areas or those who have recently suffered a wildfire-related loss have seen insurance premiums skyrocket, sometimes nearly matching the coverage limit of those policies. Insurers also have increased scrutiny and selectivity of the companies that they're willing to insure, making it even more important for insureds, especially electric utilities, to have strong wildfire mitigation plans. As a result of these skyrocketing premiums and additional wildfire exclusions, insureds have been forced to turn to non-traditional or sometimes relatively new sources of coverage. These are sort of alternative risk transfer vehicles that are similar to insurance, but have different pros and cons. It's important here when trying to put together your insurance coverage or alternative risk transfer program to consult with an insurance broker who is familiar with the area and has the capacity to sort of explore every sort of option. Because as we've seen, in California and other states that suffer from wildfire risks year after year, sometimes you have to sort of do a patchwork of coverage in order to make sure that you have sufficient coverage to protect yourself from that risk. Some insurers have turned to what's called wildfire-only liability policies, which, as the name suggests, only covers third-party liability claims arising from a wildfire. In this situation, we've seen companies who've had, both a traditional general liability insurance program that covers all their non-wildfire claims, and then a separate wildfire-only insurance program that would cover just those wildfire-related third-party claims. Insureds also have sought coverage through the reinsurance market, oftentimes by first establishing their own captive insurer, who then can reach out and obtain coverage through the reinsurance market to reinsure that risk of the captive. Companies also have used other alternative risk transfer devices, such as catastrophe bonds or CAT bonds, to mitigate wildfire risk. A CAT bond is a form of an insurance-linked security, or what's called a high-yield, high-risk bond that transfers catastrophic risk, including wildfire, to investors. Many of the major electrical utilities in California have used wildfire CAT bonds at one point or another over the last 10 years. Although given the recent fires in California over the last few years, some say that investor appetite for wildfire risk may have substantially decreased. Another option is a pooling arrangement or a wildfire fund. For example, the California legislature has established the California Wildfire Fund, which is funded by 3 California utilities, Pacific Gas and Electric, San Diego Gas and Electric, and SoCal Edison, and California ratepayers. The fund provides $21 billion in coverage for certain wildfire-related liability costs in excess of $1 billion. So the utilities first have to have either self-insurance, CAT bonds, traditional insurance, or some combination of all or some of that to cover the first $1 billion in risk. And then after that, the wildfire fund would kick in to cover certain of the costs that would arise from third-party claims after a wildfire. And then finally, another relatively new option for insureds to consider, especially in the first-party context, is for property damage or business interruption, is something called parametric insurance. This is a type of insurance that covers the probability of something happening, like a wildfire, as opposed to indemnifying the actual loss that occurred from the wildfire. This, some say, is a little bit easier and a little bit quicker to get the funds as opposed to waiting until after the funds have been outlaid by the company and then going and seeking indemnity from the insurance company. One other often overlooked area is coverage from your contractors, vendors, under either their indemnity provisions in their contracts or through their coverage as an additional insured. We have, over the last 15 years, helped our clients recover hundreds of millions of dollars from contractors, both through indemnity provisions in their policy, in their contracts, and also through their insurance as additional insured. There are a couple key things to note, though, with coverage as an additional insured. Generally, the indemnity obligations in your vendor contracts will be broader than the additional insured coverage that is available through that vendor or contractor's policy. Generally, in order to be covered as an additional insured under a contractor's policy, the liability must be caused in whole or in part by the contractor's acts or omissions. For example, a tree trimmer who fails to cut a branch that hits an electrical line. There generally is no coverage for liability resulting from the sole negligence or gross negligence of the additional insured. It is important to note that you should always review the terms and provisions in your contractors' agreements, both the indemnity provisions and also the insurance provisions, to make sure that they provide the appropriate limits that you might need. Some contracts I have seen provide that the vendor is required to procure, not less than X amount of coverage. And in some jurisdictions, courts have found that limitation, not less than, is actually the maximum amount of coverage that an additional insured can get under that policy, even if the contractor has higher limits. So just be careful with the language you use. And also note that many additional insured endorsements exclude coverage for professional services. And insurers have taken the position that tree trimming or tree inspection services and stuff like that are considered professional services. So just, again, make sure that you've got the appropriate coverage that you need in those agreements. You should always also include a provision in your contracts that allows you to have a copy of the actual insurance policy under which you are additional insured. Sometimes companies rely on certificates of insurance, but a certificate of insurance doesn't exactly prove the coverage that you have. So you should always make sure that you know, here's the coverage, here's what it says, here are the exclusions, to make sure that you are protected. As I mentioned earlier, indemnity provisions in contracts are usually broader than the additional insured coverage. They generally do not require the additional insured or the company to first seek coverage under their own policy, because usually the contractor's insurance is primary to the company's policy. And they also generally contain provisions that provide that if the contractor's insurance does not pay, then the contractor is liable for any shortfall. So again, look out for your, every year you should be looking at the contract language to make sure that the indemnity provisions and the insurance requirements meet your needs. And now I will turn it over to Michaela to talk about post-wildfire.
Thank you, Sandy. So now I'm going to discuss what are the important items to understand and to do to maximize your insurance recovery after a wildfire occurs. In particular, we're going to touch on policy conditions, and that policy conditions meaning what are the insured's duties under the policy and also the insurer's duties under the policy. Okay, policy conditions. The primary ones are notice and reporting, cooperation, and consent. And these are conditions detailed in the policy that the insured must do to get coverage. Unless there's a mitigating circumstance, which we're going to talk about in a little bit, if the insured does not do these things, the insurer can deny coverage simply for not doing them. These are the main ones to keep in mind, but there are others, so you should read your policy carefully to make sure you know what all of them are in the policy that you must do as the policyholder. Okay, notice. When is notice of a claim required? Generally, it's as soon as practicable once you're aware of an occurrence, claim, or suit. However, some policies impose strict reporting deadlines, so you must review your policies carefully. I've seen them you have to give notice of a claim within 2 months, within 6 months, within 2 years. So they can vary greatly. You really need to review the policy. Claims made and reported policies. This is important to understand the difference between what a claims made and reported policy is and an occurrence-based policy. So a claims made policy provides coverage for a claim made against the insured during the policy period, regardless of when the event causing the claim occurred. This is contrast with an occurrence policy, which covers incidents that happen during the policy period, even if the claim is later filed. You must know if your policy is claims made or an occurrence-based policy. Especially under claims made policies, if it triggers, moving on to reporting, it can trigger when the policy is actually in play. So a claims made will also be a reported policy, which says not only does the claim need to be made against you, but you have to report it to the insurance company as well. And if you fail to do that, there's no coverage under the policy. Moving on to notice of circumstance. This is also something in construction projects, in energy projects. Important to note, notice of circumstance says if there's a circumstance that could lead to a claim, do you have to give notice of it? And some policies will say, yes, you must give notice of it. And some policies will say it's optional. You need to know if it's optional or mandatory, because if you don't give notice of the circumstance and it's mandatory, you can be losing coverage under that policy. Okay, practical tips to comply with notice. And I love giving practical tips because notice seems like such an easy thing. Like, oh yes, I'll give notice under the policy, but it's surprising how often it's an issue and how often it is litigated at courts across the country. So if you just keep some basic things in mind when you're considering notice, it makes it easier to comply and not make it like, oh my gosh, I forgot to give notice. So one, if there's any chance of coverage, provide notice. If you're wavering, there might be coverage, there might not be coverage, just give notice, because if you don't give notice, I can tell you there's no coverage. Confirming policy requirements regarding notice. You should look at the policy and see where it should be sent and how it should be done. Some policies will say it has specifically what person it should be sent to, and it must be done via US Postal Service, for instance, or via email. Look at those requirements. Consider the role of your coverage counsel, your broker, your underlying defense counsel. Don't rely on the broker to give notice. If notice from the broker is not necessarily, notice to your broker is not notice to your insurance company. So oftentimes policyholders will say, well, I told my broker to do it. And that's not notice to the insurance company. So make sure you're talking to coverage counsel, broker, and ensuring that notice is actually given to the insurance company. At a minimum, state that notice is being provided. Policyholders will also often stress about what needs to be in the notice, which is important. But if you don't have time to get a full, detailed description of what happened, just say notice is being provided. We will follow up with additional information and details about the claim. Ask for confirmation that notice was received. This puts the burden on the insurance company to open a claim file, assign a claims person, and to report back that they received notice and that the claim is now open. If there's an ongoing issue, so if you have a project that's been going on for a while, determine if an earlier notice was made. And this is important when thinking about the notice of circumstance issue. You could have provided a notice of circumstance earlier, you could have provided a claim earlier, and you might want your later claim to relate back to those earlier claims or notice of circumstances. So you want to consider what has already been noticed on that project. Consider if excess insurers should be noticed. We tell clients if there's any chance that it could hit their layer, notice them right away. Don't wait until later to provide that notice if there's any chance at all that it could hit the layer. Consider other insurance policies that should be noticed. If you're an additional insured on another policy, Sandy was talking about additional insured status, should you be giving notice there as well? This is when, if you think you might want to give notice, you ask for the full policy. As Sandy said, don't rely on the certificate of insurance. Ask for the full policy so you know what the notice conditions are. And consider if other insurance has already been noticed and when. And this is important if you should, because we're going to talk about a little bit, giving updates and letting the insurer know what's going on. So if there's already been a notice provided, you might want to update your insurer on what's been going on. Okay, the cooperation clause generally requires the insurer to cooperate with the insurer in the investigation and settlement of claims of defensive lawsuits. Basically says that you have to provide the insurance company and cooperate in their investigation of the claim. It's not unlimited, however. So, oftentimes policyholders will say, they're just killing me with requests for information. It's just nonstop. They're never satisfied. And it's not unlimited. So don't feel like you have to give them everything and anything under the sun. And they also have a duty to act in good faith and not harass you or give you overburdensome requests for information. But as the policyholder, you do have a duty to provide some information that is requested so that they can investigate the claim. In particular, you should be careful of requests that violate any privilege. There isn't necessarily privilege between you and your insurance company. It depends whether they've accepted the defense, whether they've reserved their rights, or whether they've denied outright. So you really want to be careful of providing the insurance company with any information that could waive your privilege over those underlying documents. One kind of tip I'd like to give here is, even if the insurance company isn't asking for information, you should be providing them information, an update on the claim at certain intervals. So, if 3 months has gone by and anything at all is happening, you should be providing an update to your insurance company. Even if it's setting a reminder, once a month, I say, hey, insurance company, we're still in discovery, nothing has occurred. We'll keep you updated as things progress. It creates a record that you have been cooperating and keeping the insurance company informed. So if the insurance company comes back, a year later and says, you haven't been cooperating, we're going to deny coverage, you can say, no, I have a record here. I have been updating you, at monthly, 2-monthly intervals along the way. Consent and voluntary payments. This is a clause that provides that no insured will accept at the insured's own cost, voluntarily make any payment, assume any obligation, or incur any expense without the insurer's consent. Basically, it says that the policyholder will not do certain things without getting the insurance company's consent before it does it. So this can be incurring defense costs, can be entering settlements. It can be a range of things. You want to read your insurance policy, but often it'll just say, as I read, anything. So it leaves the policyholder thinking, well, how much do I need to tell them? How much do I need to get their consent on? So practical tip here is keep you apprised of the claim and litigation and seek consent for anything incurring costs, settlements, judgments. Even if the insurance company has reserved rights and you're not sure if you have to ask their consent anymore, I say, what's the harm in asking? Put it in writing, ask them, they can deny. You still put it in writing that you've made the request. You can also ask the insurance company to waive the consent provision. It depends what the situation is. It depends if the insurance company is defending, if they've denied coverage, if there's a reservation of rights, but it is an option and one you should consider. Okay, policy conditions. So just because you don't give notice within a timely period, or you haven't given the insurance company all the documents that they've requested, that doesn't necessarily mean that there is absolutely no coverage. There are ways to get around it. And this is one of those instances where if the insurance company is denying and, for not giving notice, for instance, you should consult coverage counsel, because this is often what we do to try to get around when the policyholder did not comply with the condition. So non-compliance can be excused. There can be extenuating circumstances. There's waiver and estoppel. Maybe the insurance company did something to waive their rights to impose that condition. Substantial compliance may suffice. This is often in the, do you cooperate? Did you provide the documents requested? Well, maybe you provided enough of the documents for them to investigate the claim. Prejudice requirement is also important to know about. This is, it varies different by state. So you're going to need to know what law applies to the insurance policy. But some jurisdictions require the insurer to prove actual and substantial prejudice as a result of the insured's failure to comply with the policy condition. So basically, the insurance company, to enforce the notice provision, would have to show that they were actually and substantially prejudiced by their failure to receive the notice. This often happens in occurrence policies where the event occurred, 50 years ago. You're noticing a policy that's older, decades old, and the insurance company says, well, you knew about it